The words rich people know that nobody ever taught you. Let me ask you something real quick. If someone walked up to you right now and said, hey, the VIX just spiked, the market's in correction territory, and I'm rotating out of cyclicals into defensives, would you know what they were talking about? Or would you just nod and pretend? Because here's the thing, that gap, that moment of nodding along without actually knowing, that gap is costing you money. Real money. Every single day. The stock market has its own language. And if you don't speak it, you're basically showing up to a poker table where everyone else knows the rules and you don't even know what cards you're holding. Today, we're going to fix that, for good. My name's Host Name, and this channel is about one thing, helping regular Americans, not Wall Street guys, not finance pros, regular people, build real wealth. And I'll be honest with you. When I first got into investing, I felt completely lost. I'd open up a brokerage app, see all these numbers and terms, and just close it. Because it felt like it wasn't meant for me. But here's what nobody tells you, this stuff isn't actually complicated. It just sounds complicated on purpose. Because when you don't understand it, you stay on the sidelines. And when you stay on the sidelines, someone else gets rich off the money you were too scared to invest. So today, I'm breaking down the most important stock market terms you need to know, but not as a boring glossary. We're doing this like a story. Like a map. By the end of this video, you're going to see how all of it connects, and investing is going to feel way less intimidating. Let's get into it. First things first, what even is a stock? Think about your favorite local restaurant. Imagine the owner decides to expand, open 10 more locations across the country. But he doesn't have enough money to do it alone. So he splits the business into 1,000 little pieces and sells those pieces to regular people. You buy 5 pieces, congratulations, you now own a small part of that restaurant. That's a stock. It's ownership. Real ownership in a real company. Now there are 2 main flavors. Common stock is what most of us buy. You get a vote in company decisions, like, should we replace the CEO, should we expand into Europe, stuff like that. And if the company becomes wildly profitable, your slice of ownership becomes worth a lot more. Preferred stock is different. You don't get to vote, but you get paid dividends first, before common stockholders. Think of it like being a silent partner who gets paid before the regular employees. Now, when a company decides to sell those ownership pieces to the general public for the very first time, that's called an IPO, an initial public offering. You've probably heard this term when a big company like Airbnb or DoorDash went public. That's the moment regular investors can first get in. But here's something most beginners don't realize. Not all companies are public. Apple, Microsoft, Amazon, those are public companies, traded on a stock exchange, basically a massive marketplace where buyers and sellers meet. The biggest one in America is the New York Stock Exchange, that iconic building on Wall Street with the big flag. The other major one is the Nasdaq, which is especially known for tech companies. Every company on these exchanges has a ticker symbol, a short code. Apple is Apple. Tesla is Tesla. Google is Google. It's like a nickname the market uses. And here's where it gets real for you as a buyer. The stock price is just what one share costs right now. But here's what's wild, that price changes literally every second during market hours, which run from 9:30 in the morning to 4 p.m. Eastern Time on weekdays. And even outside those hours, in what's called pre-market and after-hours trading, prices are still moving. Why does the price move? Because of volume, how many people are buying and selling. Think of it like this, if everyone in your neighborhood suddenly wants to buy the same house, that house gets more expensive fast. Same idea. Now to buy and sell stocks, you need a brokerage. That's just the platform in the middle, like Fidelity, Schwab, or Robinhood. They connect you to the exchange. Most don't charge a commission anymore, that's just a fee per trade, but always check before you sign up. One more thing here, market capitalization. This is just the total value of a company based on its stock price. You take the stock price and multiply it by the total number of shares out there. A company worth over $10 billion is called a large cap. Between $2 and $10 billion. Mid cap. Under $2 billion. Small cap. And under $5 per share. That's called a penny stock, basically the Wild West of investing. High risk, sometimes high reward, but often just high regret. Okay, so now you know what a stock is. But how do you know if it's a good deal? This is where most beginners get lost. Because prices alone mean nothing. Think about it this way. Let's say a gallon of gas at one station costs $4. At another station it costs $6. Which one's cheaper? Obviously the $4 one, right? But what if I told you the $4 station is 1 mile out of your way, and the $6 station is right next to your house? Now it's not so simple. Stocks are the same. A $10 stock can be wildly overpriced. A $500 stock can be an absolute bargain. The price alone tells you nothing. You need context. That context comes from a few key numbers. First, revenue. This is just the total money a company brings in from selling its product or service. If you own a lemonade stand and you made $1,000 in sales last Saturday, that's your revenue. After you pay for the lemons, the cups, the table, the employee, what's left is called net income. That's the actual profit. Now, divide that profit by the number of shares out there and you get EPS, earnings per share. This is how much profit exists for every single share of stock. The higher this number, the more the company is earning per share you own. Now here's one of the most important ratios in all of investing, the P/E ratio, price to earnings. You take the stock price, divide it by the EPS, and it tells you how expensive a stock is relative to what the company actually earns. Let me make this real. If a stock costs $50 and the EPS is $5, the P/E ratio is 10. That means you're paying $10 for every $1 the company earns. Now if a competitor's stock costs $100 and their EPS is also $5, their P/E is 20. You're paying twice as much for the same earnings. That second company better have a really good reason to justify that price, like massive growth ahead. Which brings us to the PEG ratio. This takes the P/E and adjusts it for how fast the company is expected to grow. Because sometimes paying more makes sense, if a company is growing like crazy, a higher P/E might actually be fair. For income investors, people who want regular cash coming in, there's dividend yield. A dividend is when a company shares a slice of its profits directly with shareholders, usually every quarter. Dividend yield tells you how much you're earning in dividends compared to what you paid for the stock. If a stock costs $100 and pays $4 in annual dividends, the yield is 4%. That's like earning 4% interest just for holding it. Now let's talk about free cash flow, and honestly, some professionals consider this the single most important number in the whole company. After a business pays all its bills and makes the investments it needs to keep operating, whatever cash is left over, that's free cash flow. It's real money the company can use to pay dividends, buy back stock, or grow further. A company with strong free cash flow is usually a healthy company. Two more quick ones. Gross margin tells you how much money a company keeps from each sale after the direct cost of making the product. Net profit margin is the final bottom line, after every single expense is paid, what percentage of revenue actually becomes profit. A 20% net margin means for every dollar of sales, the company keeps 20 cents. Higher is usually better. So now you know what stocks are and how to evaluate them. But here's a question most beginners never think to ask: do you actually have to pick individual stocks to invest? No. And for most people, you probably shouldn't, at least not at first. Here's why. Imagine instead of betting everything on one horse in a race, you could bet on the entire race at once. If any horse wins, you win. That's basically what a fund does. A mutual fund pools money from thousands of investors and a professional manager decides what to buy and sell. It's like hiring someone to handle your investments. The downside. They charge fees, called expense ratios, and most of them actually underperform the market anyway. An ETF, exchange-traded fund, works similarly, but it trades on the stock exchange like a regular stock. You can buy or sell at any time during market hours. Super flexible. But the real game changer for most regular Americans. The index fund. Here's the idea. Instead of trying to beat the market, which is incredibly hard, even for Wall Street professionals, what if you just matched it? An index fund tracks a market index. The most famous. The S&P 500, a collection of the 500 biggest companies in America. Apple, Amazon, Microsoft, Berkshire Hathaway, all in one fund. When you buy an S&P 500 index fund, you're essentially buying a tiny piece of 500 companies at once. Historically, the S&P 500 has returned about 10% per year on average over the long haul. Not every year, some years it drops hard. But over decades, it's been remarkably consistent. And because index funds don't have a fancy manager picking stocks, the fees are super low. Warren Buffett, literally one of the greatest investors who ever lived, has said repeatedly that for most people, a low-cost S&P 500 index fund is the smartest investment they can make. Let that sink in. Now there's also the Roth IRA, a type of investment account that's basically the government handing you a gift. You put in money you've already paid taxes on, invest it in whatever you want, stocks, ETFs, index funds, and when you retire and take the money out, you pay zero taxes on the growth. Zero. If you're in your 20s or 30s and you're not maxing this out, you're leaving serious money on the table. Beyond stocks and funds, a quick note on other investments you'll hear about: bonds are basically you lending money to a company or government. They promise to pay you back with interest over time. They're less exciting than stocks but much more stable, good for balancing out a portfolio. Commodities, gold, oil, wheat, are physical goods you can invest in through funds. Gold especially is popular as a safe haven when the stock market gets crazy. And of course, crypto, Bitcoin, Ethereum and the rest. Completely digital, highly volatile, trades 24/7. Some people have made fortunes. Others have lost everything. Know what you're getting into. Here's something the glossary videos never really explain: the stock market has moods. And understanding those moods can be the difference between making smart decisions and panicking at the worst possible time. When the market is rising, people are optimistic, money is flowing in, that's called a bull market. Picture a bull charging forward, horns up. Everything feels good. Portfolios are green. People are bragging about their stocks at barbecues. When prices are falling consistently and fear is taking over, that's a bear market. A bear swiping its paw downward. Everything feels bad. The news is scary. Your neighbor is telling you to sell everything. Here's what you need to know about both: bull markets are when you get rich slowly. Bear markets are when you decide whether to stay rich or not. A correction is a smaller pullback, usually about 10% from recent highs. It sounds scary, but corrections are normal. Healthy, even. The market can't just go straight up forever. A crash is sudden and severe, like what happened in March 2020 when COVID hit and the market dropped 34% in about 5 weeks. Terrifying in the moment. But guess what? It fully recovered in about 6 months. Then there are bubbles. This is when stock prices get pushed way above what companies are actually worth, driven by hype, speculation, fear of missing out. The dot-com bubble in 2000. The housing bubble in 2008. Bubbles always feel real while they're happening. Everyone thinks this time it's different. It never is. Market sentiment is the overall feeling investors have about the market. When fear is high and everyone's selling, that's actually when the best buying opportunities often appear. Warren Buffett's most famous quote: "Be fearful when others are greedy, and greedy when others are fearful." To measure fear, there's the VIX, sometimes called the Fear Index. When the VIX is high, investors are expecting big swings ahead. It's essentially a panic meter. Watching the VIX can tell you a lot about where the market's head is at. Alright, last major topic, and this one might be the most important of everything we've covered. Making money in the stock market isn't just about picking winners. It's about not getting wiped out. Diversification is your first line of defense. It just means not putting all your eggs in one basket. If you own stock in one company and that company collapses, you lose everything. But if you own 50 companies across different industries, one collapse barely moves the needle. Asset allocation is deciding how to divide your money between different types of investments: stocks, bonds, cash, real estate. A 25-year-old might put 90% in stocks and 10% in bonds. A 60-year-old close to retirement might flip that around. Your allocation should match your timeline and your ability to handle stress when things drop. Over time, your allocations drift. Stocks grow faster, so suddenly they're 80% of your portfolio when you wanted 60%. Rebalancing is just trimming the winners and adding to the laggards to get back to your target. Most people do it once or twice a year. Now let's talk about risk itself. There are two kinds. Systematic risk is stuff you can't avoid: recessions, interest rate changes, global pandemics. The whole market gets hit. There's no hiding from it. Unsystematic risk is company-specific stuff: a CEO scandal, a product recall, a bad earnings report. This kind of risk you can reduce through diversification. A few more terms you'll want to know as you get more advanced. Beta measures how much your stock moves compared to the overall market. A beta of 1 means it moves with the market. A beta of 2 means if the market drops 10%, your stock might drop 20%. High beta, high drama. Alpha is the extra return your investment generates beyond what the market does. If the market is up 8% and your portfolio is up 12%, your alpha is 4%. That's the whole goal of active investing. The Sharpe ratio tells you how much return you're getting for the risk you're taking. More return for less risk. High Sharpe ratio. You want this number as high as possible. And one more, dollar cost averaging, or DCA. Instead of trying to time the market perfectly, which nobody can do consistently, you just invest a fixed amount every single month, no matter what. $100, $500, whatever you can afford. Some months you buy when prices are high. Some months you buy when prices are low. Over time, it averages out. It removes emotion from the equation. And it works. Look, here's the bottom line. The stock market is not a casino for rich people. It is a wealth-building engine that is available to every single American, including you. The only thing standing between you and using it effectively was the language barrier. Now you speak the language. You understand what you're buying, how to evaluate it, what vehicles to use, how to read the market's mood, and how to protect yourself along the way. That is genuinely more financial knowledge than most adults in this country have. If this video helped you, do me one favor, hit that like button and subscribe, because every week we go deeper on this stuff in the same no-fluff, real talk way. And drop a comment below, what's one term from today that finally clicked for you? I read every single one. Your financial future starts with understanding. And now, you understand.